What are futures and options? Futures and options are derivatives, which means that their value is derived from an underlying asset such as a stock, commodity, or currency. The underlying asset is often referred to as the underlying or the underlying security. Futures and options are two types of financial derivatives that are commonly used by traders and investors to manage risk and speculate on price movements in various financial markets. In this article, we will provide an overview of futures and options, how they work, and some of the key differences between the two. Futures. Futures are financial contracts that allow traders to buy or sell an underlying asset at a predetermined price and date in the future. Futures contracts are traded on organized exchanges, such as the Chicago Mercantile Exchange, CME, and are standardized in terms of contract size, expiration date, and delivery location. Futures contracts can be used for both hedging and speculation. Hedging involves using futures contracts to offset potential losses in an existing position, such as a physical commodity or stock. Speculation involves taking a position in the futures market with the goal of profiting from price movements. Options. Options are financial contracts that give the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and date in the future. Options contracts are traded on organized exchanges, such as the Chicago Board Options Exchange, CBOE, and are standardized in terms of contract size, expiration date, and strike price. There are two types of options, call options and put options. A call option gives the holder the right to buy the underlying asset at the strike price, while a put option gives the holder the right to sell the underlying asset at the strike price. For example, a trader may buy a call option for 100 shares of a stock at a strike price of $50, with an expiration date of 3 months in the future. If the stock price rises to $60 by the expiration date, the trader can exercise the option and buy the shares for $50, then sell them for $60, making a profit of $1,000, $10 increase in price x 100 shares. If the stock price falls below $50, the trader can simply let the option expire and only lose the premium paid for the option. Options contracts can also be used for both hedging and speculation. Hedging involves using options contracts to protect against potential losses in an existing position, such as a stock or commodity. Speculation involves taking a position in the options market with the goal of profiting from price movements. How do futures and options work? Futures and options are often used by investors and traders to manage risk and speculate on price movements. For example, a farmer may use a futures contract to lock in a price for their crops before they are harvested, thereby protecting themselves against price volatility. Similarly, an investor may buy a call option on a stock if they believe the stock price will rise, or a put option if they believe the stock price will fall. Key differences. While futures and options are both financial derivatives, there are several key differences between the two. Here are a few of the most important differences. Obligation. Futures contracts require the holder to buy or sell the underlying asset at the expiration date, while options contracts give the holder the right, but not the obligation, to buy or sell the underlying asset. Price. Futures contracts are priced based on the current market price of the underlying asset, while options contracts are priced based on several factors, including the current market price, strike price, time to expiration, and volatility. Risk. Futures contracts carry higher levels of risk, as the holder is obligated to buy or sell the underlying asset at the expiration date, regardless of the current market price. Options contracts carry lower levels of risk, as the holder has the right, but not the obligation, to buy or sell the underlying asset. Conversely, if the price of XYZ stock falls to $40 per share on the expiration date, the investor is still obligated to buy the 100 shares of XYZ stock at $50 per share, resulting in a loss of $1,000, $50 $40 by 100 shares. Options contracts. Options give the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price on or before a specific date. There are two types of options, call options and put options. A call option gives the holder the right to buy an underlying asset at a predetermined price on or before a specific date. If the price of the underlying asset rises above the predetermined price, the holder can buy the asset at the lower price and sell it for a profit. A put option gives the holder the right to sell an underlying asset at a predetermined price on or before a specific date. If the price of the underlying asset falls below the predetermined price, the holder can sell the asset at the higher price and make a profit. For example, let's say that an investor buys a call option on XYZ stock with a strike price of $50 and an expiration date of 3 months from now. If the price of XYZ stock rises to $60,